If you're currently trading smart money concepts and you're struggling with using the right fair value gaps and the right order blocks, this is the video you don't want to miss. So stay tuned and let's jump right into it. So why don't your fair value gaps and order blocks work? Well, I'm going to be talking about 3 key elements you need to consider, and I'm going to try and keep this video as short and brief as possible, but it's going to be incredibly useful still. So what's the first element? Time. Okay. Now, if you're trading based on ICT concepts and algorithmic theory, the first and most important element you need to consider is time. Okay. The odds of a fair value gap or order block greatly increase when you're operating within specific times of day. So you can't just open the charts and take a buy or a sell just because price is within a gap or an order block. All right. And this is something that is incredibly important to keep in mind, and especially new traders when they get started learning ICT concepts and they learn about fair value gaps and see how, ICT is able to take longs in bullish fair value gaps and sells and bearish fair value gaps. They think, oh, I can just open the charts and just buy or sell any fair value gap I see. No. You have to understand that trading is about probabilities, and there are specific times of day that stack the probabilities in your favor. Okay, so the problem is that most new traders don't understand probabilities. Okay, so when we talk about trading within specific times of day, it doesn't necessarily mean that if you took a trade in a fair value gap or order block outside of those specific times of day, there are 0 chances of you winning that trade. Of course, you could definitely win the trade, but the chances of you winning are greatly diminished versus when you're trading within certain specific times of day. As traders, all we're doing is dealing with probabilities. All right. There is never going to be 100% chance that you're going to win a trade, and there's never going to be a 0% chance that you're going to win a trade. Like, that's never going to happen. There is always going to be some measure of probability that you could win. All right. So what we typically do as traders is we operate within specific times of day where the odds are not necessarily 100%, but they are greatly stacked in our favor. And that's why time is such an important element to factor in when you're looking to trade the right fair value gap or the right order block. All right. The order blocks that are created within the time zones and the kill zones that ICT has taught on his YouTube channel have a greater chance of working the way you expect or the way you anticipate, not just because they are a fair value gap and not just because they are an order block, but because they occurred within specific time windows. All right. So your job is to take trades that are stacked in your favor. And so the first and most important element to stacking those odds in your favor when you want to use a fair value gap or an order block is trading within specific time windows. Now, I personally focus on the New York session, and that typically starts from 8:30 in the morning. But specifically, I'd usually wait till about the 9:30 a.m., which is the equities open, and I probably won't take a trade till about 10 a.m. All right. I like that opening range, that first 30 minutes, when the equities markets open at 9:30, I usually like that range to be completed to understand and see which liquidity pools have been targeted, which ones have been left behind in their week. And then I go in and engage. All right. So the key references that I'm going to leave you with to do your own research, you need to figure out the time of day, the time zone, the kill zone that works for you based on your specific time in the world, right? So ICT taught specifically on time in the Market Maker Primer course and as well in the 2022 ICT mentorship. So please check those videos out. Their playlists, they are not difficult to find at all. All right, go to those playlists. He talked about the Asia session, he talked about the New York session, he talked about the London session. Okay, so you want to identify which particular session works for you, and each of these sessions has specific peculiarities that you need to study for yourself and understand for yourself. But the key takeaway from this first element is you can't just go into the charts and trade just any fair value gap or any order block without first considering the time of day that fair value gap and order block is occurring in. Is it occurring within a high probability time window? If it isn't, chances are it's not going to play out the way you think. All right, so very, very important. That's the first element. Time. All right, I'm going to go straight into the second element, which is narrative. Now, what is narrative? Narrative is generally the sentiment in the marketplace. And when you're talking about building narrative, this is something that you typically want to do from the higher time frame perspective. All right, and narrative isn't a skill that anyone can do a single video and teach you. ICT can't do a video and teach you. I can't do a video and teach you. This is something that comes after several weeks and months of learning to read price action, going into the charts, marking it up, journaling your observations, studying it day in and day out. I'm not even talking about trading it yet. All right. This is purely learning how to read the tape. All right. So I'm just going to give you some random questions, and this is by no means an exhaustive list, but some random questions and some questions that you want to keep in mind when you're reading price. All right. So you want to ask yourself, what is the underlying sentiment in the marketplace? All right. Typically, as far as fundamentals are concerned, I typically pay attention mostly to the interest rate decisions by the Fed. I don't really look at COT. I don't really look at a lot of other fundamental data because the interest rate is probably the biggest thing that impacts the marketplace. All right. So if the Fed is hiking interest rates, typically that's going to cause the dollar to go up. If the dollar is going to go up, typically stock indices are going to find it difficult to rally and they're going to drop. All right. So what is the underlying sentiment in the marketplace? Which liquidity pools have been recently raided? If buy side has been taken, more than likely the market is going to consolidate or revert to sell side. All right. Which liquidity do you see any liquidity pools that have been recently engineered? For example, what's the current institutional order flow? Right? Is the market structure bullish? Is it bearish? Right? And you want to look at this within the context of things like intermediate term highs, intermediate term lows, short term highs, short term lows. This is reading price. All right. It's not just higher low, higher high, higher low, higher high. No, this is looking at price through the lens of institutional market structure, which is what ICT taught in the 2022 mentorship, I believe in episode 12. I think it's titled Market Structure for Precision Technicians or something like that. So you can check that out. Which higher time frame PDRAs are also in close proximity of price, right? Are we trading on a higher time frame, daily, weekly, or monthly chart within a volume imbalance or within a fair value gap or within an order block, right? The higher time frame PDRAs, even if price doesn't fully reverse from there and, you know, completely change direction, typically when price reaches any of these key levels, there is some kind of reaction. So you want to note where you are currently trading in daily, weekly, monthly. I guess you could use the 4-hour as well as one of your higher time frames. If you are a scalper, you can do that. And you also want to pay attention to where we are in the current dealing range. Okay, premium or discount. If price is in a discount, more than likely it's going to want to revert to a premium. If we are in a premium, more than likely the algorithm is going to want to seek a discount or lower prices, right? Also, another example of a question to help you build narrative is, which day of week is it? All right. So for example, generally speaking, if you study this, ICT has taught this and I've studied it and back tested it as well, and I found it to be true. The high and low of the week typically has an 80% chance of forming between Tuesday and Wednesday. So if you're bullish in the week, for example, and price has formed the low on Tuesday, it has traded into, say, a higher time frame PDRA, formed the low and started to rally and rallied away from that PDRA and rallied on Wednesday all the way up, chances are, right, it is not going to come back down and take out the low that it has formed on Tuesday, right? If you have, for example, an obvious drawn liquidity above the market price, you can engage price with that expectation, with the understanding that it is unlikely, not impossible. Again, don't forget, we're dealing with probabilities. It is unlikely, but not impossible, that price is not going to tank and take out the low on Tuesday. So you want to build narrative and use that to inform your bias. Okay, how are you going to be engaging the marketplace? What is the current sentiment in the marketplace? Where are the obvious liquidity pools that you think price could be targeting? Another thing that I didn't write here that is incredibly important is intermarket relationships. All right. So if you're trading something like Euro USD, you want to be looking at the dollar index, and you want to be looking at something like the pound dollar, GBP USD. If you're trading things like the E-mini S&P, you want to be looking at the NASDAQ, and you want to be looking at the Dow Jones, the YM. All right. So blending intermarket concepts, blending macro concepts like what the dollar index is likely to do, looking at things like the dealing range, looking at things like the liquidity pools that are being engineered and the liquidity pools that can be targeted, and looking at things like institutional market flow, institutional order flow, right? You blend all of that to build a story for what price has done and use that to forecast what is likely to happen. Now, once you have built that narrative, you will know which fair value gap and order blocks are likely to hold and which ones are not likely to hold. But again, this isn't something you will know and understand just by listening to me. You need to go into the charts. You need to go in day after day after day, and it is a very laborious task. But that is the only way you're going to learn how to read price and how to pick the right order blocks and fair value gaps. Not every fair value gap and order block are created equal. All right. And the key references here is the ongoing 2023 ICT mentorship. Please check that out. That is literally tape reading on steroids. ICT is literally taking us into the charts and helping us by explaining his internal dialogue, what he sees in price, how he's reading price, what he's considering when he's looking at price. That isn't something he can do just a video and teach you, or write a book and teach you. You have to go with him into the charts and read this out and read the price action every single day. And with time, you get better at it. And with time, you begin to build and ingrain some kind of pattern recognition in your mind, and you're able to go into the charts and instinctively pick up on things even without ICT pointing them out. You will begin to pick out on things like relative equal highs, relative equal lows, fair value gaps, order blocks. You begin to see them again and again and again and again and again, and then you just get better at it. But again, this is something that takes time. You need to be patient, and it's a skill that is honed over weeks and months. And that's why you can't just learn how to use a fair value gap or order block to enter excuse me, and think you're good to go. You need to learn to read price. There's so many things to consider. For example, another key example, for example, ICT has taught that when it is the week of an NFP, you don't trade after Wednesday. That's narrative. So you start the week, you do your weekly analysis, you ask yourself, is it an NFP week? It's an NFP week. What's the protocol? My trading stops after Wednesday PM session. You don't touch price. If you're taking any trades, you're done by Wednesday. Win or lose, you're done. Thursday before NFP, what typically tends to happen is the market goes into consolidation. What is it doing? It is engineering liquidity to use during the NFP on Friday. So you don't want to touch the market on Thursday, and you definitely don't want to touch it on the NFP Friday. All right, that's narrative. Now, the last element, which is the most common element, which everybody focuses on, is the technicals, right? So with regards to the technicals, I'm looking at three things. Number one, a run into a pool of liquidity. And if it's a higher time frame liquidity pool, even better. Even better. Okay. I will only engage a fair value gap or order block if we just had a run on buy stops or sell stops. Okay. So if we've had a run on buy stops, I would be willing to start hunting a fair value gap or order block to engage. All right. Number two, shift in market structure with displacement, i.e. a fair value gap. All right. So say, for example, we have a run on sell stops. All right. We have a run on sell side liquidity. And then right after that, we have a bullish shift in market structure with displacement, fair value gap. That's something I want to engage. But if I don't see a pool of liquidity being ran, and I see a displacement or I see a fair value gap, I would be very skeptical about engaging something like that. So I like to see a pool of liquidity being tapped, buy stops or sell stops. This should obviously be within the time window that I would be looking to engage, which is 9:30 a.m. New York time. And also, they should also be in line with the narrative that I have built from my higher time frame perspective. Okay. And the third element, which is optional, you don't need this, is when your fair value gap or order block overlaps with another PD array. So say, for example, and it happens a lot of times with a lot of my trades, right, where we have a raid on sell stops, we have a bullish shift in market structure with displacement. So we have a fair value gap, but at the same time, there is a breaker. The fair value gap overlaps with a breaker. That is a very high probability trade. Or for example, we have a shift in market structure with a fair value gap, and there's an order block right below the fair value gap or right above the fair value gap. That is a very high probability trade after we've run liquidity based on my narrative within the time window that I'm looking at. All right. So the technicals is what 90% of smart money traders focus on. They want to understand the entry pattern, how they're getting in, but nobody likes to talk about the other two elements, the time and narrative. Your technicals will have a low chance of playing out as you expect if you don't blend it in with the first two elements. There are times of day where you read the narrative in price, you read the order flow in price, and you can tell we are likely to have a range bound day or a choppy day, and you don't engage. You may see fair value gaps, you may see order blocks, but you do not engage. Why? Because the narrative in price is showing you that the algorithm isn't in a hurry to reprice to any higher time frame liquidity pool or any higher time frame imbalance. So what do? You sit on your hands. But that is a skill that comes with time. So you need to submit to time. ICT says this all the time. Submit to time. Submit to time. You need to submit to time and learn how to read price within the time window that you're looking to engage. And then you can go in with your technicals. And then you can go in with your entry pattern. All right. And the key references here for me that I'll leave you with is the 2022 ICT mentorship and the 2023 ICT mentorship as well. In both of these series, he talks about the technicals, the entry patterns, the liquidity pools, the breakers, the new week opening gaps. He talks about everything. All right. But he himself will tell you if you don't blend in time and narrative, it doesn't matter the entry pattern that you have. Odds are you're going to wreck yourself. So in summary, those are the three key elements: time, narrative, and technicals. Okay. And one of the things I should mention is I do have videos on my channel about liquidity, very, very in-depth liquidity like you've never learned. Like there's nobody on YouTube, nobody who is teaching liquidity in depth like this. And it is very beginner friendly. I made it specifically for beginners. So if you want to understand, when we talk about buy side liquidity, what is that? When we talk about sell side liquidity, what is that? And then how can we use that to enter trades? All right. I have videos and I'm going to link them in the video, in the video description below. And I'm going to link them in the cards as well. So be sure to check that out. But yeah, those are the three key elements. And if you focus on these elements, your strike rate, your win rate when you are engaging fair value gaps and order blocks, the number of times that they actually pan out will go through the roof. They will definitely go through the roof. So if you enjoyed this video, please be sure to give it a thumbs up and subscribe to the channel. I've got more content coming out, and I will catch you in the next one. Cheers.